What's going on, guys? Welcome back to another video. So in today's video, I'm going over options trading on Robinhood, but we're going a little bit more detailed than just a basis overview on this. What I'm going to be discussing today is a never lose strategy on trading options. This is honestly something I wish I would have been doing for years now. It's a true way you can earn passive income every single week just by trading these types of options on Robinhood. I'm actually going to hop on the computer and show you guys a real-time options trade in my Robinhood portfolio. That way you guys can see and exactly understand just how this never lose strategy actually works. And real quick, before we hop on the computer, I do want to say if you guys are interested in joining in on the Discord chat, I have a link down in the description. I talk everything from options tradings, my real-time buys and sales of all the stocks that I'm purchasing, and pretty much anything stock related goes on in that Discord chat. It's a lot of fun. It's honestly one of my favorite things I look forward to, getting on in the morning and hopping on the Discord. I'm on there almost every single day except for the weekend. So if you guys are interested in that, click the link down below in the description. So without further ado, let's hop on the computer. Okay, so this strategy that I am talking about that is a never lose strategy for trading options is what is known as covered calls. Now, covered calls, I'm going to try and explain this as easy and as quick as possible here, and I'm actually going to showcase a trade or me performing a covered call on my Canopy Growth stock. Now, there's a couple things to keep in mind when you're performing or buying a covered call, and we are going to jump into all of that in today's video. So, the first thing to understand with a covered call is basically you writing up a contract to say that you will be able to sell 100 shares or however many contracts you come up with. One contract equals 100 shares. So basically what that's stating is you are writing up this contract to say you are okay to sell your shares at a certain price. So let's look at this a little better to get a better understanding of this. So right now the share price of Canopy Growth is $14.57. So if you want to perform a covered call, the way you do this is go up here in Robinhood and click sell, and then you have call selected already. So to perform a covered call, you have to own at least 100 shares of that company, whichever company you're going to perform that covered call on. Now, me having Canopy Growth, I have to own 100 shares of Canopy Growth. And as you can see here, I own exactly 100. I just purchased some new shares yesterday to be able to perform this covered call to showcase to you guys, but also to let everybody know on the Discord chat. So let's go back into this and to showcase to you guys exactly how I'm going to do this. So one thing you need to keep in mind when you're doing a covered call is your average cost of whichever stock you're performing the options trade on. So for me, being Canopy Growth, I know I have an average cost of $15.10. So let's go back over here and look at this. So basically what this is telling you is when you are doing a covered call, like I mentioned earlier, if let's say I do this $15.50 strike price right here, that's stating that if I do a covered call at the $15.50 strike price, that means if the break-even point is $15.69. So pretty much what you can tell is if Canopy Growth gets up to $15.69 by the expiration date, which right now is set for October 2nd, that means that call could be exercised. So basically what that means is there's somebody who's going to purchase this call, and then they will be agreed to purchase the 100 shares at the $15.50 or $15.69, whatever that may be. Now, why would I do that? What is in that for me? So the cool thing is you earn what is called a premium. So what this premium is the 17 cents right here. So I don't actually earn the 17 cents. So like I said earlier, is one contract equals 100 shares. And we're going to run through this as an example to showcase to you guys exactly how this works. So just try and stick with me on this. I know this is probably a little confusing if you've never heard of this before. So if I end up doing this covered call at the $15.50 strike price, it shows the premium of 17 cents. Now, you have to multiply that by 100 because this is the premium price. So it gets multiplied by however many shares you're going to be doing for this covered call. Me, I'm going to be doing one contract, so it's 100 shares. So 100 times 0.17 is $17. So that premium, as soon as I make this covered call, that's mine. That's $17. That premium is mine to have. I can pull it out. I can do whatever I want with. I can go buy lunch or whatever I may do. Usually I just buy another share of whatever stock I'm performing the options trade on, which would be Canopy Growth. So like I mentioned earlier with this expiration date of the October 2nd, if Canopy Growth does not get to the 15.5 or the 15.67 and no one purchases that contract, then that premium, again, is yours to keep, and you don't have to sell your 100 shares. Now, the other thing you have to keep in mind with a covered call is if let's say Canopy Growth does shoot up by tomorrow or later today, and then someone does actually purchase this contract, then I have to sell my shares at the $15.50 price. Now, that's something you need to keep in mind here. So with my average cost being $15.10, I will not only be earning money on the premium, the 17 cents here, it would be $17 multiplied by 100, but I'm also going to be earning capital gains. So with my share price being here, let's do this real quick to showcase to you guys. Oops, that's the wrong thing. Exactly how this math works. Let's put this right here. So if I have 100 shares at the $15.10, which is my average cost, the total value of that is $1,510. So let's say the stock price does go up and I end up having to sell the 100 shares because the covered call gets performed, then that is going to be 100 times the $15.50 strike price, having me to sell the shares at $1,550. So I made $40 in profit on capital gains. Now, one thing to keep in mind here again with a covered call is you don't want to be doing covered calls on stocks that you do not want to sell out of your portfolio. So, for example, if you own Microsoft, I own Microsoft in my portfolio. Microsoft isn't probably a stock I want to be performing a covered call on because I don't want to have to sell those shares. I'm wanting to hold that company for the long term. So, any stocks I own in my portfolio or that you own in your portfolio that you wouldn't feel comfortable selling or getting rid of, then I would say probably isn't the best fit for a covered call. Now, Canopy Growth, I'm fine if I have to sell my shares at whatever strike price I agree with, because I'm trying to do this for some quick income for the week. So something else I wanted to mention on was these expiration dates. So you can actually take an expiration date out a lot farther than just this week. I like staying a week or two because, well, you get the quicker passive income and you can do this over and over again. But let's say you wanted to go all the way out till January. So you can see just how much higher these premiums are. So if I did a $15 strike price, then that actually, if it never hits $15, if Canopy Growth never goes over $15 for the next till the end of the year, which is highly unlikely, then I'd earn this premium. I earn their premium no matter what if I make the covered call, but I get to keep my 100 shares, and I get to earn this $2.07 multiplied by 100. So I'd get $207 in premium and get to keep my 100 shares. Now, if it would go over the $15 strike price, then I'd have to sell my 100 shares for the $15, which would actually be a loss for me because my average cost is $15.10. So you don't want to do that. But you also get the premium even if you have to sell your shares as well. So, like I said, you can kind of mess with these expirations, see which ones you like, see if the premiums are a little higher. So for example, looking at October 2nd, the $15.50 strike price is 18 cents, and if I hold it a week longer, the $15.50 is 35. So almost doubles. So basically, just for waiting another week to see if it gets to $15.50, I could more than double my amount of my money. So basically, I could go buy 2 shares of Canopy Growth, or I do it this week and then I do it the following week as well. There's so many different ways you can do this. But basically, that's it. I mean, that's kind of how you perform a covered call. Again, you click the sell, call option. You have to make sure you own 100 shares of whichever stock you're wanting to perform this covered call on. And then this is how it's a never lose strategy. So let's say I do the 50-50 strike price. Canopy Growth never hits that price mark, so my options expire. I get to keep $17 and my 100 shares, and basically I profited $17 on just riding this call option. That's how this works. Now, if by Friday the stock price of Canopy Growth goes above $15.50 or like the $15.67 here, then I have to sell my 100 shares. The option gets exercised. Then not only do I earn my $40 in capital gains, but I also earn the $17 in premium as well. So no matter what, you're getting this premium, which is the cool part. So if you have, 500 shares, 1,000 shares of Canopy Growth, you would multiply that 0.17 instead of by 100. So let's say you do 10 contracts, that's 1,000 shares. So 1,000 times the 0.17, I know I don't need to do this in a calculator, but I'm doing this to show you guys. That's $170 in premium you get just for riding the call option. So you can see how quickly you can earn passive income from performing covered calls, and how basically it's a never lose strategy. Now, there are some downfalls with this, And one of them would be, let's say you do write this covered call for the 15.50 strike price, and then on October 1st, Canopy Growth shoots all the way up to 20 bucks. Well, you missed out on all of that growth. So that's also something to keep in mind here. And that's something that could happen with Canopy Growth. They've known to been shoot up 2-3% in a day. So it's something you need to be okay with if it does happen. Now, again, I wouldn't be doing this with a stock that I want to hold long-term in my portfolio. Canopy Growth is a stock I do want to hold long-term, but it's also it's a stock I could buy back at these levels if I just am patient and wait till the stock price drops back down. Obviously, unless legalization happens in the U.S. or whatever. But that's basically how it works, guys. So what I'm going to do here is I'm actually going to buy this covered call option with Canopy Growth at the 15.50 strike price, expiring on October 2nd. And then if you guys want, I'll do a little update video on how that performed. Or if you want to join along with all of my other trades and my stocks I'm purchasing, again, you can sign up for the Discord chat down in the description. Okay, so let's go ahead and set up this covered call. So I am good with the $15.50 strike price expiring October 2nd. Just click continue. So contracts, I was talking about this earlier. I only have 100 shares of Canopy Growth, so I can only write one contract. If I had 200 shares, I could write 2. If I had 300, I could write 3, so on and so forth. So I'm writing 1. I got the limit price in here. We're going to do 16. So here's another thing. You can set it lower at the 16 cent premium. That way you for sure will get this to write up. I'm just going to leave it at the 17 just to make this happen. And then let's go ahead and click review order. So here again, I want to kind of showcase to you guys this. The minimum credit here. The minimum premium you can earn is $17. So if this covered call does not get exercised by October 2nd, I get my $17. Even if it does get exercised, I still get to keep my 17 bucks. I just also get that capital gains on me selling at 15.50. So let's click review order. Submit. Bam. All right, it's been placed. So that's done. That's easy as it gets, guys. I mean, and again, I have never actually bought calls or puts or anything yet. I did try to do one a few months ago, and it actually just never went through. So that's things to keep in mind here. This is a never lose strategy, in my opinion, whenever you're wanting to trade options. I also think it's a more safe way to trade options if you're relatively new to trading options like I am. I am no expert whatsoever when it comes to trading options. This is something I am just starting to do. I'm learning as I go when it comes to options. Stocks I've been buying for a while now, for years, but I'm just now getting into the options game. Pretty a risk-adverse guy, so I like to be less risky as possible, especially when I'm starting something new. I like to be safe if I'm going into something I'm not, a very 100% comfortable with. That's just kind of the guy I am. So that's it, guys. That's the covered call strategy. That's a never lose strategy on how to trade options on Robinhood. I really hope you guys got some value out of this video. If you did, please make sure you hit that like button. So basically that's it, guys. That's the covered call strategy. That's kind of that never lose strategy on how to trade options on Robinhood. And until the next video, you guys take care.